Your thoughts on the recent market move post Balakot? We had that surge, but that coincided with, of course, global markets also moving up, emerging markets. But now we're seeing a bit of a fatigue. You know, your thoughts on the overall move?
So my broad view is that post what happened to the way Fed has given their broad indication of not incremental anymore cuts. Those are normally very good for emerging markets, and we've seen a huge emerging market rally. India hasn't participated as much. As of yesterday, emerging markets are up almost 13-14%. China is up almost 22%. We are up 5-6%.
From?
This is year to date.
Ago.
Yeah, year to date numbers. So, and broadly, if you look at across the board, most markets are up 10-12%, a few barring here and there. So I think there's a catch-up trade for India. So India has their own issues. I mean, beginning of the year, some of the NBFC issues were plaguing the markets. Plus, we have an election coming by. So I think once the dust settles down, we'll see that India will participate far better than what it has participated right now. So we remain positive on the markets. We think this is a global environment which is conducive for emerging markets in general, and India would participate eventually.
Okay. India is also one of the better valued markets, even when it is in a downturn and not getting the benefit of FII flows. Now, how would you rate the earnings season that's just ended and the one that we are now in? Do you think that can spook investors, or do you think things are on the mend?
So I think the earnings are going to be mixed. So we know already that discretionary has taken a hit. And whereas financials may show slightly better results because of reduced credit costs that they will have. So I think the earnings are broadly priced in. I don't see too many surprises as far as earnings is concerned. What has also happened is that many stocks have corrected. If you take 1 year back prices, barring a bunch of 10 stocks, you take the rest of the market, they've had a significant correction. So your risk reward is slightly better right now, keeping a view that some of them may be a cyclical trough that you're going through, and it is up to investors to take a constructive view based on whatever assumptions you can make and build a portfolio for the next 3-4 years. It doesn't mean that if you buy today, the earnings are going to come tomorrow, especially for a lot of the cyclicals and discretionary. But based on historical assumptions and data that you have, it always plays out well when you buy good companies when cyclically they are at a low.
Did I hear Maruti in between?
I didn't say much. I don't want to talk about stock specific, but auto surely is something that is worth looking at.
Maybe by the end of this discussion, we might try and get some stocks out of you. I won't promise that to our viewers. But nevertheless, just keep an eye out on the markets, because there's a bit of a recovery that the market is attempting right now. And the stocks that are batting for the bulls are the banks. ICICI Bank is up almost 0.5%. SBI is up almost about 0.3%. So looking okay from the financial end. I mean, that at least keeping the market afloat at the moment. But Sridhar, hi, morning. You mentioned that the NBFC crisis is something that is still a bit of a problem.
Right.
Do you think that could mean more market share for banks, and would you put more money to work in the banking space?
Yeah, so we've been very positive on banks for the last 18 months, especially the corporate banks. I think a lot of it is played out. We've seen significant rallies in some of the corporate banks, so I would have to admit that it's a consensus trade right now. But having said that, the way NBFCs have behaved and the entire crisis is evolving, and we are seeing some of them wanting to, merge with banks. We've already had two instances in the last 1 year. I think the writing is already on the wall that for a long-term sustainable business model, the NBFC model cannot sustain after a point of time. That if you cross 1 lakh crore of assets, it becomes that much more difficult. So I think the banks are in a sweet spot right now where NBFCs are really wanting to figure out if the business model is correct. The growth rate that NBFCs are having of about 30-40% is, I think, something of the past, and they'll have much more muted growth. As a result, the banks will have a good time. The other thing I hear from banks is that the pricing has improved. Because the NBFCs are so aggressive, they were actually, very aggressive on the pricing. So that has abated. So broadly, I would say it's looking good for banks in general.
One sector which has made a comeback, it's not a big sector, but there are some big stocks here. There's real estate, Godrej Properties, DLF has made a comeback. There's South-based real estate stocks anyway have done well. Is it worth looking at the sector?
So My view is that the commercial end of the real estate is looking really good. And if somebody wants to play the real estate, I think the REITs is a very good option. We already have one listing on that, and I'm sure there'll be more listings. And generally, when I speak to people in the real estate, the sense we get is that the supply on the commercial space is much more restricted than on the residential space. So I'm not a bull on the real estate stocks as such, especially because a lot of them have a huge residential component to it.
Okay. Which part of the financials are you playing? You said that you're not confident of NBFCs,
right,
though some of them have managed themselves beautifully,
exactly,
especially consumer finance guys. Yeah. But any part of NBFCs, but more importantly, which ones would you want to buy?
So in the financials basket, banks surely.
I mean, see, there are these mid-caps and small caps which we don't talk about at all.
Yeah.
I mean, it's always HDFC, Kotak, SBI, ICICI, Axis. What beyond that? No.
So I think I think the differentiation between a consumer and a corporate bank is fading now. The consumer banks that we used to say are no longer consumer, and the corporate banks that we normally refer to are no longer corporate because they also have consumer. So I think it's for people to do their own analysis. But banks as a space is looking fairly good. As long as you do your due diligence, because...
Will you buy the top 5 or will you go down the pecking order for whatever reason?
I think you can go down the pecking order. There's no issues going down the pecking order because they have a business model also. And some of them are trading at much far better valuation. In fact, we are also open, I mean, we do have exposure even to the PSU banks, especially the top 2-3 PSU banks, because they have similar plays, which is that credit cost is coming down and the opportunity for them also is looking good. On the NBFC side, the consumer-facing NBFCs are far better placed than the ones who have a large exposure to even corporates. So I can't understand NBFCs wanting to lend to corporates, which the banks can anyway lend. So you're borrowing from a bank and then lending to a corporate and competing with the same. So that business model, I think we tend to avoid. I know there are fans to that, but yeah.
Okay. So that point is taken, that you stay away from NBFCs and stick with the corporate-facing banks. What about discretionaries? I know you've said in the past that the best time to buy autos is during distress.
Yeah.
Would you buy the larger names like the Hero Motors of the world, or would you now get into the smaller auto ancillary companies?
So discretionary, we are bullish both on auto and auto ancillary because we think that this is a cyclical phase that they are facing. So when the autos go through cycles, the ancillaries obviously have the same pain. But we think that the cycle will turn maybe in 12 months, 6 months. We don't know the exact time. But a lot of them are trading at very attractive valuations. When you look at a 10-year chart and look at the valuations where they are, they look very attractive right now. So discretionary, not only auto, even media, which also falls in discretionary, is something that we are quite bullish on because a lot of them are cash flow rich companies. And because of the fear of OTT and many of the other innovative changes that are happening, the valuations have come down significantly. And they have no debt, they have a brand. So I think that's the other part within the discretionary that we like.
Okay, your thoughts overall on the broader market. We had a big rally in 2017. Some part of it was cost of capital rally, some because post demonetization, a lot of money moved into mutual funds. Then we had that sharp correction last year. You reckon we could have a outperforming broader market this year towards the end, second half?
Yeah, if I were to guess, I think the broader market will outperform this year. I think 2017 was an exceptional year. I think even some of the newer people who came into the market thought that they were better than Warren Buffett because every stock they touched, everything was doing well. And I think 18 was a reality check. So I guess it's good for the industry as such because many people haven't seen cycles. So when you go through cycles, you know that this is something very normal and you have to, insulate your portfolio to such events. So I think 2019 is going to be a fairly good year. When we end the year, we'll have more smiling faces than what we had when we ended the year of 2018.